Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back to another edition of All Things Financial. I wanted to talk today about the different forms of life insurance. Many people are confused about needing some form of life insurance or feeling like we need life insurance, but are unsure exactly what form to do and get overwhelmed with all the different terms. Universal life, term, whole life. It's a situation now where you have a choice, and I want to help you with the differences in making the choice. Let's start with annual renewable term, which is the core of all life insurance policies. A lot of people don't know that, but all life insurance is actually based on annual renewable term, which is a one-year term insurance policy based on your age at this point in time and your health, what you can qualify for, what the premium is to buy 1 year's worth of life insurance in a given amount. So if you say, I need $100,000 life insurance, it all starts with, and every other form of life insurance actually starts with, annual renewable term first in their pricing. And again, you're just buying 1 year's term insurance. The company is calculating what the price is, and at the end of that year, you can decide whether you want to buy another year or not. The insurance company, in their policies, when they issue an annual renewable term, normally guarantee you the right to continue renewing that policy year after year, but at another new rate, based on another new age. They normally will not punish you or penalize you for any health problems, though, because once you have that policy, an annual renewable term, the word renewable means it's automatically renewable at that same rate class. It does go up every year as you get older, and it goes up incrementally as you continue to get older. So the increase might be when you're 30 to 31 age, might only go up $3 for that year. But when you're 81 and it goes to 82, it might go up $100 a year. So that's what I mean by incremental increases. That is a summary of annual renewable term. It is the cheapest form of insurance. It's buying 1 year at a time, and it's guaranteed renewable typically. Many of those can also be convertible into other forms of more permanent insurance, so check into that also. I'd like to get into, when we go past annual renewable term, we get into these fixed term periods, and this is what you see advertised on the radio and the internet. Term insurance can be bought for a lengthy period of time with a guaranteed rate. And it's usually a 10-year term, 20-year term, or 30-year term. It is a level term, and that's what it's referred to. Term insurance means there's no cash value coming on to the policy to build up for a cash value account for later years. It is strictly insurance. It is strictly term insurance for a specific term. So that's why they call it term insurance. Now, what you see advertised, it does depend on health, what your rates will be. So you'll be rated preferred, or you'll be rated standard, or you'll be rated table rated. Let's say if you have any health issues, you might be a table rating 1, which is a surcharge, 2, 3, or even 4. So if you have some health issues, your rates will be different. If you have some health benefits and you meet those doctor's tables, every time you go into the doctors and they say, here's the height and weight chart on what you should be to be healthy, it's very hard to meet those charts. And if you do happen to meet those charts, you're probably going to get preferred or even ultra preferred rating classification discounts. So that'll help you, especially when you buy term insurance. Now, when you buy level term, you have a choice usually to buy 5-year, 10-year, 15-year, 20, and 30. You can't find more than 30. So it's like a mortgage. You normally will not find longer than a 30-year term. If you're looking at term insurance, the shorter amount of time the company is committed, the lower your rate will be to buy that whole term. But the benefit of buying level term insurance is this. Unlike annual renewable term where the rate goes up every year, whatever term you pre-choose and pre-package, 30-year term insurance, they will calculate, the insurance company will calculate what the level premium every year will be that they will charge for that level term. And that premium will not change throughout the whole term of 30 years. You will pay the same annual premium for that whole length of term that you've chosen. So be careful what term you choose if you're looking at term insurance. Please don't assume that if you buy 10-year term insurance, because it's less expensive, you'll just keep buying and flipping it over into the next 10 years and then the next 10 years after that. Please don't assume that you can continue to keep buying or even be eligible to buy the next 10 years worth of insurance after this first 10 years has expired. I've seen too many cases where it's not that the premiums go up too much, but they do go up. But it's normally that your health situation changed enough that you may not qualify for that same ultra preferred or even standard rating anymore. And in some cases, a health issue comes up where you cannot qualify for any insurance after an accident or something like that. So be careful when you're initially choosing to buy level term insurance. Probably my best recommendation would be buy a longer term than you think you will need. So if you have a 20-year mortgage and you think a 20-year term ought to be okay, you might want to consider the price difference between a 20-year term and a 30-year term just to be safe, and that's just a recommendation. But that is a brief explanation of level term insurance. At the end of that term, those policies can continue, but those rates are extraordinarily high because they're non-guaranteed. So get those illustrations first before you make any choices. Now let's talk about something called universal life. Universal life insurance is a combination of term, annual renewable term, with an excess premium charge going straight into cash value, a cash accumulation account. Now, cash value is an excess premium that was not needed to cover that year's insurance costs and the insurance company's expenses. So let's say it would cost, and as I said, all policies are built on an annual renewable term chassis. So let's say you were purchasing $100,000 life insurance, and an annual renewable term at your age 30, let's say, might only be $80 for the year. So you go to a company and you say, I want to buy a policy that lasts longer than that. And they talk to you about many different forms of insurance, and then they hit on one called universal life. And you say, what's the difference? And they say, well, universal life builds a cash value. And you say, does that run out like those term policies in 30 years or 5 years? They say, no, that policy is oriented to last forever. And you ask, is it guaranteed to last forever? And the companies typically say, it depends on the premiums that you're giving. So if that sounds complicated, it's because it is. So what you do is you ask them for this. What's an illustration for guaranteeing me that my policy will last to age 100, let's say you'd ask them, or age 120 on a guaranteed basis. And then you would also ask them, I'd also like to know what the premium would be on current assumptions basis to last to age 100 or 120. Folks, that is an excellent, excellent recommendation right there. If you just ask for those two things, you will get the whole picture on universal life. Now, universal life insurance is designed to last your whole life, but it is not typically guaranteed to last your whole life. So what can go wrong are the rate increases for the life insurance portion, which does increase every year, might increase too much over the initially estimated annual premiums that they thought would be enough to cover it. And the cash value interest rates might also become lower than initially projected and make the policy what we call blow up or run out of money or run dry, run through all its money, deplete its resources, and go broke. The policy would go broke. Not the company going broke, but you could lose the policy. And you could find out at age 80 or 78 or so, hey, your policy is going to run out for insufficient funds, and it's too late to do anything about it. So get those reports, I recommend, early before you purchase, and you'll know exactly how much premium you have to pay every year if you want to guarantee the policy never cancels or lapses by age 100 or 120. And you'll also have another proposal that says how much the annual premium would have to be based on current assumptions. If you would say, well, I don't want to pay that much to guarantee it, but based on current assumptions, how much would I need to pay every year to be pretty certain the policy won't run out of money on me? That's universal life, folks, and you'll run into, if the policies run well, an interest rate on the cash value account, which is the excess premium every year above, let's say that $80 I used as an example. You might find your annual premium being proposed is $300 a year, where only $80 of it is needed for this year's life insurance portion and the company expenses. Where does the rest go? $220 goes straight into a cash value account for you that is building inside your policy for you. And it is also earning interest for you. And that cash value account grows and helps subsidize future increases in premiums. Designed properly, it can last forever and be a permanent form of life insurance for you. Okay, there is a form of insurance that is a hybrid term and universal life. It is called guaranteed universal life. Now, I look at this as really being more like a guaranteed term insurance, and here's why. Universal life, as you know from my prior explanations, does build some cash value. Guaranteed universal life is a stripped down life insurance policy. So here's what we're looking for. Guaranteed term, and they don't make it. So if you ask someone, you go online and shop, or you ask an agent, I would like guaranteed term insurance. I don't want it to run out in 10 years or 20 years or 30 years. I want it to when I'm age 100, let's say, or age 120. So you say, why age 120? Because I want it guaranteed for when I die, no matter how long I live, not if I die before age 100, let's say. So that's the reason. So they say, well, there is no such thing as guaranteed term. So here's what the insurance companies came up with. Universal life allows some excess premium to go into cash value. Well, a guaranteed universal life policy is built to simulate what a guaranteed term insurance would do. That is outside the 30-year term. You say, what's the annual premium I need to pay? And you can pay these annual premiums monthly. You could divide them by 12 and pay them monthly. What's my annual premium? And can we lock it in that my premium's the same forever, for every year, so that it doesn't go up as I get older, and you, the insurance company, offset that by maybe averaging out all the premiums that you would need. So here's what they do. The insurance companies typically take and calculate what's your 1-year term cost, your 2nd year estimated term cost, your 3rd year, and they do that through age 100 or 120. And they figure out what the life expectancy premiums and mortality costs will be. They add them all up and divide them by that 70 years or 30 years or 50 years or however many years it is until age 100 or 120. Now that's a simplified explanation. It's not exactly how they do it, but it averages out all the premiums for the whole length of the time. And a guaranteed universal life means they guarantee that premium not to change. And they do guarantee that life insurance to stay in force. So here's how they do it. That excess, what do they do with that excess premium in the earlier years? There is a small cash value accumulation account that grows, but it's only for the sake of ending up at zero. It is designed to end up at zero. So you're not going to have any cash value left. The only reason there's a little surplus or excess is to cover the additional amounts in the later years so that you're paying a flat premium account and they could take the rest from that cash value and deplete the cash value on purpose. So you end up at age 100, zero cash value, but your life insurance is in place, or at age 120. There's no residual cash value at the end. But that's like buying a permanent term insurance. So please don't forget to ask agents, when you're looking at a 30-year term policy, which does run out in 30 years, hey, can you give me the price on a guaranteed universal life, which is really like a permanent term policy? Maybe the premiums are so much higher you can't afford them, and maybe they're not. So you need to check both, and you'll be surprised at the results. Now I'd like to talk to you about the king of all life insurance, and probably one of the oldest forms of life insurance, which are referred to as whole life insurance. Whole life insurance is widely misunderstood, but whole life insurance is basically a core policy incorporating all of the aspects of life insurance. That's the term portion of the premium, cash value buildup. If it's a mutual company, there are even dividends. These policies can become very cash rich. These policies can become highly valuable cash accumulation vehicles, where you might have a situation where you look at, for example, a whole life insurance policy, and you ask, what's the annual premium for a whole life insurance? It will be very expensive in comparison to all the other forms of life insurance. So you might find at any age, if you said, what's an annual renewable term insurance for my $100,000? And they might say $100 a year. You'd say, what's a 30-year term? And they might say $300 a year. You'd say, what's a guaranteed universal life? And they might say $500 a year. You'd say, what's a universal life? And they might say $1,000 or $1,500. It'd probably be about $1,000, let's say, in this example. And then you say, what's whole life insurance? And they'd say it's $2,500 a year. Those increments might really happen if you'd shop that way. So why would anybody buy that expensive of a policy when they can get one for so much cheaper? Here's why many will. We're putting a cash outlay, in my example, of $2,500 every single year for something that we could have gotten for $300. Why would we do that? Well, most of the premium is going toward cash value. The company is never usually charging a whole lot more than what that year's mortality and life insurance costs are anyway. So what you're finding is you might have a whole life insurance policy that after 10 years, you've paid, in my example, $2,500 a year, which is way overpaying over all the other forms of insurance. Over 10 years, you've paid $25,000 for a $100,000 life insurance policy, let's say. But what would happen if you discovered in that same policy, you now had a death benefit that might have pushed up to $150,000, and you might have $20,000 or $25,000 of cash value, your own cash value, if you canceled the policy, how much money you would get back. Now, if that happened and you saw that scenario in a whole life insurance policy and you paid $2,500 a year for 10 years, $25,000 a year, and I'd ask you, how much did that policy cost? You'd say $25,000. And I'd say, if you cash it in, how much is it worth? And if it is $25,000, I'll ask you again, how much did that life insurance over the past 10 years cost? If you get your whole $25,000 back. Your answer might now be, well, it might not have cost me anything. It didn't cost me anything. I got all my money back. And I might have had the 10 years life insurance for free. So if you're fronting an overage or an excess amount of money, much more than is needed for the actual cost of the life insurance, but at some point you have a potential to get all your money back, that might turn whole life insurance, which is the most expensive form of life insurance, into actually being the least expensive, and in actuality, ultimately maybe even free coverage for all of those years along the way. So that's why people are looking into whole life insurance, where I'm not knowing that they would discount whole life insurance. We get into that area of whole life insurance and we begin to see major benefits that aren't available in the other forms of insurance. So when you're looking for life insurance, compare all forms before making any decision. Now what I'd like to talk to you about is, once you understand all the basics of the different forms of life insurance, number one, how to compare them all. And I also want to get into the topic of, we've heard it's better to buy term and invest the difference than to buy a permanent form of insurance that actually accumulates the cash values for us. So let me get into that a little bit. The comparison of all these policies: annual renewable term, level term, guaranteed universal life, and whole life. All of these forms of insurance serve a different purpose, and it usually is length of the time that you need the coverage, amount of insurance premiums you want to stay fixed for a certain period of time, and the amount of cash values you want to accumulate or not. So the big discussion is, are we better off to buy term and invest the difference, or are we better off to buy one of these permanent forms, universal life or whole life insurance, and allow the companies to do it for us? There are advantages and disadvantages to each. The advantages of buy term and invest the difference can include that you're making the choices of where to invest the difference. So you can choose any form of account that you wish to put that extra that you would have given the insurance companies to manage for you, and put them into any other area that you want. One of the issues in investing on your own is incurring risk of loss. So you might actually have a theory of invest the difference and end up losing half of that invest the difference part because the markets went down. And you might have lost some of that money, where you were planning on the whole goal being, I'll buy 30-year term insurance, I'll invest the difference, And by the end of the 30 years, I'll have enough in the investment account that I'll no longer need the life insurance because the investment account will have grown high enough to equal what the life insurance death benefit was, and I won't need it anymore. That's one of the philosophies buy term and invest the difference. What goes wrong is sometimes the markets go down unexpectedly, you are unprepared for it, or you're mismanaging. You're not a professional manager in many cases, and you're guessing wrong or getting caught in some market turns that you were unaware of or unprepared for, and lose that invest the difference portion, and it blows that whole plan. So at the end of 30 years, you are shopping for more insurance because you still needed it, and your invest the difference account didn't accumulate enough to replace that death benefit account. So here you are indeed shopping for insurance later. So that's one big problem frequently run into. The other big problem, even more frequently run into with the invest the difference side, is people stop investing in the difference. You know, every month you're doing that, and then bills come up and the furnace goes and you need a new roof, and you stop the investment plan temporarily, or you lose your job and you stop the investment plan temporarily, and then you get another job 6 months later and you never resume the investment plan even though you could. It's not on automatic pilot. It's not automated like the permanent life insurance. The bills come out, you pay the bills, they're automated. The invest the difference plan is not, and the invest the difference plan dies. So there's no cash value account accumulating anymore, and you're truly left with just a term policy. But the benefits of buy term and invest the difference can also be very valuable. The invest the difference might succeed, and the invest the difference might actually earn more and grow greater and faster than the insurance company's accounts internally would have grown in your cash value accounts. So you might win by having actually more in the invest the difference side than you would have had in the company cash value accumulation side. So it's a calculation, it's an estimation, but it's also a gamble. So you have to factor into your own situation. How comfortable are you with gambling with your own financial security and your family security? Because that's what we're dealing with here. We're not dealing with your retirement planning as much. We're dealing with your family security. That, in a nutshell, though, I wanted to talk about a little bit of the comparison, permanent versus term insurance, and buy term and invest the difference. I hope that all helps. I appreciate you all tuning in, and I'll see you again in another edition of All Things Financial.